Alibaba is down almost 6% today after it reported its earnings. It's also the only Chinese stock I currently hold in the YouTube portfolio. The stock has continued taking a beating and is selling right near its all-time lows. No matter what the business reports, it seems like investors are just simply not interested in Alibaba or any Chinese stocks right now. So today, I want to go through Alibaba's earnings report and give you my updated thoughts on the business and on the stock today. In this video, I will answer if Alibaba is looking cheap, explain what my plan is for my shares, and if I will be buying more or selling them. Before we get into the video though, I just want to let you all know that my book, The Fundamentals of Investing, is officially available on Amazon. And thanks to so many of you ordering my book already, it has become the #1 bestseller in the stock market category on Amazon. So if you're interested in learning more about fundamental investing and learning how to find stocks that can compound wealth over the long term, then consider checking out my book. I will put the link at the top of the description as well. And with that being said, let's now hop into the video and Alibaba's most recent earnings report. So as usual, I put together a little bit of a Daniel Pronk slideshow. So let's start with Alibaba's business highlights from its most recent earnings report. This says that revenue came in at about $36.7 billion US, which is an increase of about 5% year over year. So Alibaba's revenue is in fact growing year over year. However, if we take a look at the income from operations, we can see that it was about $3.17 billion, which is a decline of 36% year over year. So Alibaba's revenue is growing, but it looks like its profits are declining right now. The company says that this was primarily attributable to the impairment of intangible assets. So this is actually a non-cash charge towards Alibaba's operating income and its net income. So what I will do later on in this video is take a look at their cash flows to see if the cash flows are increasing or decreasing, because the cash flows remove these non-cash expenses that can actually lower operating income. But before we get there, let's take a look at Alibaba's income statement and the different business segments of Alibaba. So here we can see that Alibaba's e-commerce segment grew by 2% year over year, and this is by far Alibaba's largest area of the business. Now the Cloud Intelligence Group grew by 3% year over year, which I like to see, but I do think that Alibaba's cloud business should be growing faster, especially when we take a look at AWS, Google Cloud, and Azure all growing at double-digit growth rates. So Alibaba Cloud only growing at 3% tells me that this business is not nearly as competitive or as desirable as the other large cloud providers out there. Alibaba's new CEO did say that they want to start focusing more on Alibaba's cloud business. So we're going to have to see if this growth does accelerate in the coming quarters. But for now, it's not really growing that much. Alibaba International Digital Commerce Group grew by 44% year over year though. So Alibaba's international business is growing quite strong, and this is also a pretty large business as well. So I do like to see this because it does mean that Alibaba is growing around the world and outside of China. Its smart logistics network also grew by 24% year over year, which is a pretty good growth rate as well. So really Alibaba's growth is coming from its international segment and its smart logistics network, which is good to see. Now, overall revenue did grow by 6% year over year, but again, we can see that income from operations declined by 36% and net income declined by 77%. Now, in my opinion, this is probably why Alibaba's stock is down 6% today, because I don't think that the market cares that the revenue is growing. I think the market is focused on Alibaba's profitability right now, and seeing its net income drop by 77% year over year is not a good thing to see at all. So now let's move on to Alibaba's cash flow statement, which is my personal favorite financial statement. So here we can see the net cash provided by operating activities did decline year over year for the fourth quarter. We can see that last year it was at 87.4 billion RMB, and this year it came in at about 65 billion. So that is a decline of about 25 to 30% year over year to operating cash flow. Now, in terms of US dollars, this means that Alibaba generated about 9.1 billion USD in the fourth quarter. In the 9 months ended December 31st, Alibaba has generated $22.4 billion in operating cash flow though, which is a significant amount of cash flow. So even though the company's cash flows are declining, this business is still generating well over $20 billion in cash flow per year, which is pretty significant. Now, if we take a look at the free cash flow, it did come in at about $8 billion for the quarter, which is down also about 30% year over year. And the free cash flow in the 9 months ended December 31st is now sitting at about $20 billion if we round up. So the company is again producing over $20 billion in actual free cash flow for its shareholders. Now, again, this is personally why I think Alibaba's stock is down, is simply because its profitability is declining. Now, if we move on and take a look at the business's balance sheet metrics right here, This is pretty bullish. Alibaba's cash position is sitting at 36 billion US dollars. Its short-term investments are sitting at 42 billion US dollars, and its other treasury investments are sitting at about 14 billion. So Alibaba's total cash position is sitting at 92 billion US dollars now. It is almost at $100 billion, okay? This is starting to approach a Google level cash position. That's ridiculous. Now, Alibaba also shows us the net cash position here at the bottom, which is about 68.6 billion now. So when we factor in all of Alibaba's debt, its net cash position is basically $69 billion. That's a lot of cash that the business is sitting on right now. Now, this next slide shows us the adjusted EBITDA that each business segment of Alibaba generates. So we can see that its e-commerce business generated about 60 billion RMB in the previous 3 months. The Cloud Intelligence Group generated about 2.3 billion RMB. And then Alibaba International actually lost 3.1 billion RMB. It is not producing any profits or adding any profits to Alibaba's bottom line. I do think that over the long term, this will definitely change, but this is the business segment that is growing 44% year over year. So if I am taking a look at this, and if I were Alibaba, I would want to be investing as much capital into the business segments or the areas of the business that are growing the most rapidly. So I don't think that it is unusual to see that this area of the business is growing 44% and it is producing some losses right now, because I think Alibaba is just dumping a ton of money into continuing to grow this segment of the business. Now, the smart logistics network is actually slightly profitable and generating about 961 million RMB for Alibaba. So this is basically where the company's focus is, in my opinion at least. I think that Alibaba is going to focus on these 4 segments of the business and not really these ones right here. These other segments are smaller segments of the business that are also losing money. We're going to talk about that a little bit later on in the video. Then Alibaba talks about its capital management and its share buyback. So this says, during the quarter ended December 31st, we repurchased 292.7 million ordinary shares, equivalent to about 37 million ADR shares, which is a total of about 2.9 billion US dollars. For the calendar year of 2023, Alibaba also repurchased about $9.5 billion worth of shares. So Alibaba is repurchasing a lot of shares right now. They then continue on and say our share repurchase program resulted in a net reduction of 3.3% in our outstanding share count. So their share count did decline by 3.3% year over year. Our board of directors has approved an increase of 25 billion US dollars to our share repurchase program through the end of March 2027. Following this upsize, we currently have $35.3 billion available under our share repurchase program through the next 3 fiscal years. So Alibaba is actually wanting to repurchase $12 billion of shares on an annual basis right now, which is actually at its current market cap around 4% of its shares annually over the next 3 years. So if they execute on this, then the shares could decline by a roughly 10 to 12% over the next 3 years. And that is how the company is returning cash to shareholders. Now, this next screenshot is actually from the transcript of Alibaba's most recent earnings report. And this says, we are targeting a 3 percentage points per year accretion per year over the next 3 years through our buyback program. So this is Alibaba basically saying that they want to buy back 3% of their shares on an annual basis over the next 3 years. We're anticipating that our stock will increase in price over the next 3 years. So that we could still keep our target at 3% accretion per year. So this is kind of, I'm sorry, this transcript is coming from Quarter. It's kind of not the best, but basically what they're saying is that due to their expectation of the stock price increasing over the next 3 years, that is why they are keeping their target at 3%. Because again, if they actually repurchase $12 billion per year at the current market cap, they could buy back 4% or more with the $12 billion per year. So they're expecting the share price to grow, and that is why they're saying 3%. Then they continue on and say 3% accretion a year plus a dividend of $1 per ADS. The dividend yield is equivalent to about 1.4%. So combined with the 3% buyback, accretion, and the dividend yield, you're looking at about 4.4% to 4.5%, which is actually quite close to the 10-year treasury yield today. So if you buy Alibaba stock, it's like you bought a 10-year treasury bond with the upside of stock price appreciation. So that's the math we're looking at. So Alibaba's goal is basically to deliver the same percentage return as a 10-year government bond from the US. So basically with Alibaba, there's a 3% buyback per year plus a 1.4% dividend yield, which equals 4.4% return to shareholders annually. And then they're coming in and saying, that is the amount of cash we want to return to our shareholders. And then on top of that, if you buy the stock, you're probably going to get some share price appreciation as they turn around the business essentially. So that is how the management is thinking about capital allocation right now. Now, continuing on, this article came out last week, which says, Alibaba considers sale of consumer assets, including Freshippo, RT Mart sources say. So Alibaba is looking to divest or sell off some of its assets that are losing money. Further down in this article, it says, Alibaba Group is looking to sell a number of consumer sector assets, including grocery business, Freshippo, and retailer RT Mart. Shifted focus back to its profitable e-commerce business model while divesting non-core loss-making units. So earlier on in the video, when we were taking a look at the different business segments and their EBITDA produced, I underlined those 4 business segments that I think Alibaba is going to keep and focus on. And I think that the other business segments they're just going to get rid of. Continuing on, this says, with the change of Alibaba's management, they are more focused on their core business, which is obviously domestic e-commerce, and they want to invest more in AI, cloud computing, and also overseas expansion. So this is the focus of the new management. They want to focus on domestic e-commerce, which is highly profitable and basically Alibaba's cash generation machine. Then they want to invest in AI, cloud computing, and their overseas expansion. As we saw, their overseas area of the business is growing by 44% year over year, and we did see that cloud computing grew by 3% year over year. So with the management refocusing on cloud computing, I hope that we will see a little bit more acceleration and growth to this business. Now, if we head back over here to stock unlock and we head over to Alibaba, again, we can see that the stock is down 6% today, and the market cap is now sitting around $197 billion. So after Alibaba's 6% drop to its market cap today, it is now trading for about $185 billion. Now, in the trailing 12 months, Alibaba has produced about $26 billion in free cash flow, which means that the business is selling for roughly 7 times free cash flow right now. However, if we consider that Alibaba also has $68 billion of cash on the balance sheet, then we can go to $185 billion in market cap, subtract the $68 billion in cash on the balance sheet, and this means that Alibaba's enterprise value is roughly $117 billion today. Now, the reason that I like to focus on the enterprise value for these businesses with large amounts of cash is because if we're buying this business, think about if we buy Alibaba outright today for $185 billion. Let's say we have $185 billion of cash, we want to buy Alibaba's business. Well, if we buy Alibaba's business at $185 billion, with our cash, then we're also buying $68 billion of cash, which means that we're essentially buying cash. So the enterprise value just like takes out that cash position, factors it out of the market cap because it's cash buying cash. So the actual business of Alibaba, its operations, are selling for about $117 billion today. Now, the operations selling for $117 billion divided by $26 billion in annual cash flow that they produce is an enterprise value to free cash flow of 4.5. This is ridiculously cheap. This is like, well, I'll show you. If we divide 100 divided by 4.5 enterprise value to free cash flow, this is a 22.2% yield on cost, okay? What this means is Alibaba could theoretically deliver or return 22% to their shareholders every year through the cash flow that the operations generate and the cash on the balance sheet. So when I take a look at how much cash Alibaba can return to its shareholders versus the price of the business today, it is significant. This business could easily deliver in the double-digit range for shareholders. Like if the business wanted to, it could take its free cash flow and use 100% of the free cash flow and just buy back as much stock as it could, and it could buy back roughly 20% of the shares on an annual basis today. And another way to put this is Alibaba, if they wanted to pay out all of their free cash flow as a dividend, they could pay out a roughly 20% dividend today to shareholders. That is ridiculous, okay? And if this business is actually going to continue growing its free cash flow over the long term and become a more efficient business and get growing and accelerating its growth again, then I think that it is incredibly cheap today. Now, obviously, people do not want to own Chinese stocks in the market. It seems like China-wide investors are just not interested in China right now. So this whole sector is seeing a lot of pessimism. And when investors are pessimistic about a sector, that is how you get these cheap prices. I mean, think about Meta and at the end of 2022. People thought that Meta was done. People thought that Snapchat was going to disrupt Meta's business. People thought that TikTok was going to overtake Meta. Meta was investing in the metaverse, and people were not sure if this business was going to really have a future. And the outlook for Meta's future was the most uncertain that I have ever seen it. There was a lot of pessimism towards Meta, and that is why the business was selling for a 9 price to free cash flow very briefly. As we then saw, the business went through its year of efficiency. They increased the margins. They got the profits back to an all-time high. And now everyone loves Meta stock and it's selling for a very high price ratio. So the market was pessimistic, created an opportunity for Meta to become undervalued. The market became optimistic, and now it is arguably expensive once again. Now, for Chinese stocks, the market is very pessimistic, way more pessimistic than it was against Meta. A 4.5 enterprise value to free cash flow, okay? That's very low. However, I don't know when the market will become optimistic on these stocks once again in the future. But what is important to note is that the market at one point was optimistic on Chinese stocks historically. And I'll show you what I mean here. So if we take a look at Google's price to free cash flow versus Alibaba, actually, let's take a look at the price to operating cash flow because I want to get Amazon in here. So if we take a look at the price to operating cash flow of Alibaba, Amazon, and Google over the past about decade now, we can see that back here in 2017, Alibaba actually had the highest price to operating cash flow. So the market was most optimistic on Alibaba in 2017. We can see that Alibaba's price to operating cash flow is actually in a line with these businesses until 2021. Right here in the first quarter of 2021, Alibaba's price to operating cash flow was 21.4, which was right in line with these other two businesses. However, since 2021, look at what has happened. Alibaba's shares have gone all the way down to a price to operating cash flow of 6, while the other two are remaining right around 20. So the market in 2021 has clearly become very pessimistic towards Chinese stocks, but it wasn't always this way. So basically the investment thesis in Alibaba is that the market will eventually correct this massive undervaluation of Chinese stocks at some point in the future. Now, I do not know when that point will be, but at some point, I do think that the market will correct this undervaluation and at least price Alibaba's stock at a more sane level. I don't know if it will get back to a 20 price to operating cash flow, but even if it gets back to 12, that would be a double in the stock price. So I think that there's a lot of pessimism in Chinese stocks right now, specifically Alibaba as well, but the company is generating over $20 billion in annual free cash flow, growing its cash position, buying back shares, and now paying a dividend. So what am I doing with my shares? Well, I am simply holding on to them. Alibaba is already a pretty decent size in the YouTube portfolio, and the position is down quite a bit. And the rules that I set for the YouTube portfolio is that I cannot add cash to it, and it has to remain fully invested. So in the YouTube portfolio, what that means is I would have to sell a stock to buy more Alibaba. And at the moment, I do not want to sell a stock to buy more Alibaba, so I am just going to be holding on to my shares. But those are my thoughts on Alibaba, its price today, its valuation, and its most recent earnings report. I do like to see that the revenue was growing, but I do think that the profits need to start growing with the revenue once again and getting those profit margins back up. So if you did enjoy this video, then please remember to leave a like on it. And if you would like to learn more about fundamental investing or investing in general, then you can go and check out my new book on Amazon, The Fundamentals of Investing, which is also now a #1 bestseller in the stock market category on Amazon. It's a great book, and I think that you will enjoy it. So again, if you want to learn more about investing, then go and check out my book. But that is going to wrap up the video for today, everyone. So thank you so much again for watching. I truly do appreciate it, and I really hope to see you all again in my next video.